Good day, Hans. At the end of February, the US and Israel started attacks on Iran. Now, 1 month later, the conflict is still ongoing. I assume that the evolution of this war remains very unpredictable.
It is indeed, and so I think it's really uncomfortable. First of all, I should say again that it's very difficult for the people living there in the region. Secondly, it still seems that the US has no strategy. It's clear that the Trump administration is looking for an exit, but it remains to be seen whether he'll be finding one in the upcoming weeks. And so, as for now, we can say that given the disruption done to oil and also some damage to gas infrastructure, that the time really is ticking here. And so the longer this takes, the longer the problems, or the bigger the problems at least, will be. And there are really already some clear knock-on effects on other commodities, such as fertilizer prices, aluminium prices, outright emergency calls in some Asian countries. So I think this is escalating, and if the US escalates further, which is still a big risk, then I think we haven't seen the end of it, because Houthis may well then block the Strait of Al-Mandeb, and so that's also a strategic route for oil and gas, so very difficult.
There seems to be a parallel with Russia's invasion in Ukraine now 4 years ago. At that point in time, we saw energy prices rising sharply. It even led to an energy crisis in Europe. And at the same time, we just came out of the corona pandemic. How do you look at both situations? Are they comparable?
Well, it rings a bell, doesn't it? But I think still that there are some clear differences. First of all, when Russia invaded Ukraine, inflation already stood at 6%. So the latest reading is 1.9%. Of course, inflation is going up as we speak, but that's a clear difference in entry point. The second difference is that there's no such thing as a positive demand shock right now. That was the case 4 years ago, when there really was this willingness to spend and consume again. And the same goes for the labor market. The tightness that we saw 4 years ago is not present at this point in time. There's still some resilience, but not a really tight labor market. And so the risk of employees demanding higher wages at this point in time is way less. And then fourth of all, and I think that's also an important point to make, is that the ECB entered 2022 with a deposit rate of minus 0.5%. As of today, the policy rate stands at 2%, and that is much closer to the so-called neutral policy rate.
At the same time, Hans, we've seen that prices are already rising, and then, of course, the question is what will be the real impact on inflation? What are your thoughts about that?
Yeah, indeed, inflation will rise quite significantly, and so it could easily go to 3.5%, 4% in the Eurozone. That's our scenario. But I think we still should make a distinction between, on the one hand, the direct and the indirect effects, and on the other hand, the second round effects. The direct effects are, of course, very much linked to the steep rise in energy prices, oil, gas. Oil is up more than 60%, gas more than 70% in Europe. Then we have the indirect effects, so the energy prices spilling over into higher transportation costs, food costs, obviously, that will also go up. But on the other hand, we are not expecting at this point in time yet a wage price spiral, whereby employees demand higher wages and companies then being forced to also increase their price setting.
Then, Hans, let's take stock of the financial markets. We've seen volatility, yet no panic so far. What are the adjustments that you've made to your investment strategy?
Yes, our strategists and portfolio managers are thinking of this in terms of risk management indeed. So they're making some adjustments. And that means that they have trimmed equities, both in Europe and across emerging markets. And on the other hand, they've also reduced the so-called duration of the bond portfolios. So not a whole lot, but just trimmed the interest rate sensitivity of the bond portfolios, alongside also giving a bit more exposure to our dollar position.
Now, Hans, let's conclude with some news. You've just completed a note about Europe. What is it all about?
Yeah, indeed. So it's basically it's a summary of a study trip that I did together with my colleague in Paris. So we went to Frankfurt to see how the German stimulus program, so in terms of public infrastructure and defense spending, adds up vis-à-vis the latest rise in energy prices. And so how does this compare? Does it cancel out? That's the question we are asking ourselves. And how structural are these investment decisions now being taken in Germany, on the one hand, and on the other hand, we try to look at the ECB. What is the ECB going to do? Markets are already pricing in 2 to 3 rate hikes over the next 6 months. But as we are confronted with a negative supply shock, and also the fact that Europe actually needs so much investment, it begs the question whether increasing rate is really the wisest thing to do. And so we push back a bit against those rate hike expectations that are already present in financial markets.
Hans Bevers, thank you very much. I'm looking forward to reading your insights in that note.
Thank you.